Hello everyone. So today again we are going to talk about a very important topic in international finance, and that is your triangular arbitrage in currency. So after the end of this session you will be well equipped with the knowledge of this triangular arbitrage, and believe me that if you understand this particular concept very clearly, you will be kind of sitting on a very good concepts that can benefit you in future when you start trading in currency market. Okay, because this currency market is very liquid in nature, and it is not traded in only one country. This is not limited to one country. This is actually very well diversified, and it is traded across many countries. So whosoever countries are dealing with this exchange rates because of the supply and trade and demand, right? So all those countries will be having their exchanges over which this currency pairs they trade, right? So it might happen that if suppose you take an example of USD or INR. So in India, the price of USD INR could be different from the price of USD INR, which is trading on United States of America. So because of this mispricing that exists for very less period of time, so what happens ultimately, what is the logic behind if you find something is selling at a lower price at one place and the same thing is selling at a higher price at some other place? So what ultimately comes to your mind? Ultimately, what you will think of in your mind? Certainly you will think that why should not I go and buy the same item at a cheaper rate and sell that item at a higher rate, because that is you are observing, right? It is in front of you, that opportunity is in front of you. But if you don't avail that opportunity, someone else will avail that opportunity. So this opportunity exists for very less period of time. So this opportunity can be understood for a very conceptual topic that is known as your arbitrage. Arbitrage is nothing but it is the simultaneous purchase and sale of same or similar assets in different markets, right? So this word is very important: simultaneous purchase and sale of same or similar assets in different market in order to profit from the tiny differences in the assets listed price. Okay, it exploits short-lived variations in the price of identical or similar financial instruments in different markets or in different forms. Okay, so as I said that this opportunity exists for very short period of time until prices becomes equal in different market. Okay, so we'll be understanding this topic in a very comprehensive manner, right? So let's understand it better. Arbitrage trades are made in stocks, commodities and currencies, and this is our topic today, that we will be finding this opportunity in currency market. Okay, suppose as I said that for the same currency pairs like USD and Euro, this is the price which is quoted in United States of America, right? And this is the price you find on Germany exchange, right? So what you observe here, the price in United States of America is different from price in Germany, right? So what you can think of in your mind, you will buy from United States of America and you will sell in Germany, because you buy at lower prices and then you sell at higher prices. So whatever is the gap is your benefit, right? So arbitrage is simultaneously buying USD Euro in USA and selling USD Euro in Germany. So this trade has to be executed simultaneously, that means together. Okay, so risk less profit. So once you execute buying and selling at the same time, that means you are closing off your position, you are squaring off position at the same time, right? So you are making risk less profit, and that profit is equal to your 0.0010 per USD for 1 euro. Okay, so this is the arbitrage. So there are instances wherein inefficiency exists across different markets, where one market is overvalued and another is undervalued. So because of that, this price difference exists, right? So this price differences between exchange rate exist for a very short period of time, providing an opportunity for arbitrageurs. So who are these arbitrageurs? Those who do arbitrage trading, those who find this arbitrage opportunity to make riskless profit, they are known as your arbitrageurs. And in order for this form of arbitrage to be profitable, a trader must trade quickly with a large amount of capital. Okay. So what is triangular arbitrage? So this is the definition of triangular arbitrage, because here three currencies will be involved. So earlier we tried to understand the arbitrage concept through two currencies, right? But that rarely happens. Okay. But in case of where if we mix three currencies and then we try to find out the arbitrage opportunity, then certainly you will be successful in finding the arbitrage opportunity in most of the time, right? And this is what we are studying today, and that is known as your triangular arbitrage. So it is the result of a discrepancy between three foreign currencies that occurs when the currencies exchange rates do not exactly match up, right? So these opportunities are rare, and traders who take advantage of them usually have advanced computer equipment and programs to automate the process. So they have like automated softwares, like algorithm they have. So whenever that algorithm or the code or the command, they find that there is an arbitrage opportunity, there is a mispricing between the currency pairs, so they immediately execute the buying and selling together to cover that riskless profit, and then they make profit and then they exit the market. So this is what we are going to study. So we'll be understanding this with an example. So this is the example. So as I said that three currencies will be involved. So the first currency is your USD, second currency is your INR, and the third currency is your Great Britain pound. Okay. So these are the exchange rates which are given here on the screen, and which are trading on three different markets. So the first one is that 1 USD is equal to INR 82.10, that is trading on Mumbai Currency Exchange, sorry. Then the second one is your 1 Great Britain pound, which is equal to your 120.50 INR, which is trading on London Exchange. And the third one is 1 Great Britain pound is equal to 1.6231 USD, which is trading on New York Exchange. Okay. So now question continues that one of the arbitrageurs has USD 1 crore. Okay, 1 crore USD, one of the arbitrageurs. That means that arbitrager, that trader is a citizen of US or an entity of US or a bank of US. So they have this 1 crore USD in their hand, assuming that there are no transaction cost. So transaction cost is not involved in this. So transaction cost is something that is the that you can understand with the brokerage charges that you give to the exchanges for buying and selling these currency pairs. So for time being we are ignoring that. Okay. So explain whether there is any arbitrage gain possible from the quoted spot exchange rate. So you need to find it out if there is any arbitrage opportunity, and if there exists arbitrage opportunity, what is the profit that the US entity will make out from here. So before proceeding further, since the arbitrager is a citizen of US or an entity based out in US, so we'll have to first either convert this USD in some currency. Okay, then we'll have to check the arbitrage opportunity if that exists into these three currency pairs in these three countries or not, right? So to do that, first we'll have to find the cross rate, right? So first we need to find the USD rate which is given in the direct quote, right? So which of these three are the direct quote for a US citizen? Remember the concept, direct quote is what? When the price currency is the domestic currency, when the price currency is a domestic currency, that is known as your direct quote. So among these three, this third one is your direct quote for a US citizen, because this says that 1 Great Britain pound can buy 1.6231 USD. Since USD is the price currency, that is in numerator, so it is the direct quote for United States entity. So this we will not change. This we will not change. We will freeze this. Remember, this is the first stage. Now apart from these two, Apart from the other two, we will try to find out the exchange, the cross rate, exchange cross rate of the same pair. So from this USD and INR and GBP and INR, can we find out the cross rate between USD and GBP? Yes, we can find it out. So that is what we are going to do it here. Why we have not touched this? Because this is the direct quote for US entity. Because arbitrager is based in US, we will not touch this. We'll keep this ideal for time being. And with the other pairs of currency which is trading on other two markets, we will try to find out the cross rate. So you already know that how to find the cross rate in the previous classes and in the previous videos. In length we have discussed like how to calculate the cross rates, right? So using these two, find the cross rate of USD and GBP. Okay, then we will compare that rate with the USD and GBP which is given, which is existing in New York, right? So let's start that. So considering these two currency which is trading on Mumbai and London, we found that USD GBP rate is equal to your USD oblique INR into INR oblique GBP. This is the method of finding out the cross rate. So ultimately you find what? The cross rate is 1.4677, and you already have this direct quote for a US entity. So here USD oblique GBP is equal to 1.6231 and here it is 1.4677. So this says that in 1 GBP one can buy 1.6231 USD, and here 1 GBP can buy only 1.4677. So here you observe that there is a difference. That means there is an arbitrage. So to execute and to make the riskless profit, what you do, you buy where the prices are less and you sell where the prices are more. So this is what you will do. You will buy here, okay, and you will sell here with this quote, right? So how do we go about and do this, right? So this will be the first stage. Since you know that you have this currency pair, right, which is trading in Mumbai, so you already have this is trading on the market, and you have 1 crore USD. So in 1 crore USD, how much Indian rupees you can buy? So that you need to calculate. Okay, so since 1 USD was equal to 82.10, so 1 crore USD will be equal to multiplied by 82.10. So that will give you this much, right? So in exchange for USD, you have this much amount of INR with you, right? And with this INR, what you will do, you will buy Great Britain pounds, right? So for that you will have to go to London Stock Exchange. So go to the London Stock Exchange, where the 1 INR is equal to 0.0083 GBP. If you convert this, if you inverse this, you will get this price, right? So that already you know that how to convert this into INR and GBP. So once we have this rate, so we can convert this much amount of INR into GBP, which will give you ultimately this much of Great Britain pounds. So what will you do with this GBP now? You will bring this GBP in New York and then you will buy USD. Okay, so since 1 GBP is equal to 1.6231, so 6814300 GBP will be equal to this much amount of USD, which will give you this much amount of USD. So remember here, initially you had 1 crore USD, now you have more than 1 crore USD in your hand, right? So you visited 3 stock exchanges. Since you found that there is a mispricing, there is a difference between the currencies pair which is trading because of the 3 currencies which are involved here. So you try to gain profit from the arbitrage opportunity. So ultimately, once you had this 1 crore of USD, now that has become more than that, right? So to find out this arbitrage opportunity, what are the steps involved? This I have explained in detail, that you need to go through once again. You can repeat this. It is a similar process that I executed just now. Okay, so what is the riskless profit, triangular arbitrage profit that has this particular entity has made. So that will be equal to your 1060290 USD. That is the profit this particular trader or arbitrager has made. So I hope you understood the concept of what is triangular arbitrage and how this particular concept helps the currency traders to make riskless profit, and that riskless profit itself is known as your triangular arbitrage. So this involves 3 currency pairs, and you need to visit 3 currency exchanges to execute this trade, right? So this was all about today's concepts. I hope you understood the concept better. If you have still got any kind of doubt, you need to go through the direct quote videos, right? So the videos in which I have explained in detail that what is direct quote and what is the cross rate calculation, how the cross rate is calculated. So all those concepts, once you are through with that, you come to this video again and you watch this video, and again these concepts will be very clear to you, right? If you still get any doubt, you can contact with me, right? So that is all about today, right? Thank you so much for giving time. All the best.